Good evening, everybody. Welcome to our first Finance139 YouTube presentation. I'm Sean Vegan.
And I'm Ruben Zamora.
And tonight we're going to be discussing the valuations between two very popular sports apparel companies in the market, both Nike and Under Armour. Before we begin, we wanted to mention that there are a couple groups in Finance139 that have these companies in their presentation as well. So we wanted to make sure that everybody was aware they might have slightly different information than what we have. So with that being said, let's begin. So the first thing we're going to discuss with both Nike and Under Armour is their shareholder information. Now, there's a variety of shareholders that invest in both Nike and Under Armour. Usually these are institutional investors, but there are four companies in particular that have a very significant percentage of investments in both Nike and Under Armour. They consist of BlackRock Institutional Trust, Vanguard, State Street Corporation, and the Northern Trust Corporation as well. Now, with these companies that invest in both Nike and Under Armour, they have a percentage of about 65 to 67% equity in these companies. Now, what that means is that they have a significant influence in their company, and these companies basically have to align their interests with these companies because 67% is not something to take lightly. The next thing we want to discuss is whether or not investors care about the cost of capital. And in short, they should, because the cost of capital really determines the capital structure for a particular company and also the rate for growth and expansion and how efficient they're going to operate in the market. And this is usually done through two primary methods. It's done through debt and equity. Now, for debt, for both Under Armour and Nike, there's usually a significant loan agreement that's made between some kind of financial institution, whether it's a savings and loan, an investment bank, or even a large commercial bank that will operate with both small and large companies. For Nike, we were able to estimate that the cost of debt, as far as the after-tax measure, was about 2.19% for Nike. And then for Under Armour, we were looking at about 4.95%. So you can tell there's a slight difference between these two values, but as we continue on later in the presentation, there's going to be a larger gap, especially when it comes to equity. Now, we also have various factors to consider when measuring the debt financing for both Under Armour and Nike. You have to consider the risk-free rate, which for our evaluation was about 3%. We also had the risk premium, which was 5%, and then the corporate tax rate, which was 40%. We also have the bond ratings for these companies as well, which we're going to evaluate later in the presentation. For equity financing, as I mentioned before, there's a significant difference between Nike and Under Armour. We have a theory that it's kind of a broad theory, but the reason for this is that Nike has been around and operating in the market a lot longer than Under Armour has. Under Armour has only been around since 2005, whereas Nike has been around, I believe, since the 80s, somewhere in between that. And equity is usually in the form of ownership from another outside investor, as we mentioned before. Those institutional investors are going to have a pretty large stake in both Nike and Under Armour. Now, for the cost of equity, we were able to calculate Under Armour had a final amount of about 11.4%, and then Nike had about 5.7%. So like I said, you're looking at almost a 6% gap in between these two values, which is pretty significant when you look at all the factors that go into that, such as the beta, which for Under Armour was about 0.02, and Nike, which had a beta of about 0.51. And in addition to that, you also have to consider the risk-free rate and the risk premium. Now, I had mentioned that you also have to look into the bond ratings for various companies to determine how secure and how volatile their investments are going to be in the market. For both Nike and Under Armour, they're rated in the Class A range. So basically, that's going to signify that their investments are pretty secure. Investors have a lot of confidence in that they're going to be able to meet their financial obligations and not default on anything. So I think that's definitely a very positive sign to be in that type of range. And then the last thing we wanted to discuss before I hand it over to Ruben was the overall cost of capital for Under Armour and Nike. With the various values that we calculate, such as the market value and the cost of debt and equity, as well as the debt ratio, the equity ratio, and also the preferred stock ratio, we were able to find the WACC, or the weighted average cost of capital. And this is basically going to determine how large and how efficient their cost of capital is used and allocated throughout their business. Under Armour has a WACC value of about 2.30, and Nike has a WACC of about 5.65. So again, there's going to be a little bit of a difference there, but there's a lot of things you have to consider when measuring these two values. So now I am going to hand it over to Mr. Ruben Zamora, who's going to take over for the remaining of the presentation, and he's going to take it away.
All right, thanks, Sean, for sharing that information. So as Sean had mentioned, after reviewing our set of data between Under Armour and Nike, the next question is, can we lower the cost of capital in both of the company's capital structure? And respectively, yes, we're actually able to. And one way of doing this is by capital restructuring. And this can be done simply by replacing debt financing with equity financing. But in order for a company to be successful in doing so, it needs to have a valid strategy in place in order to be able to fulfill any financial obligations that are needed and to remain stable for funding capabilities. Typically, throughout the life of a business, it is known that the longer the operating cycle is, the easier transition it is to replace debt financing with equity. So therefore, as Sean had mentioned in the presentation earlier, Nike has a higher probability of being able to perform with more equity than debt, while Under Armour has been operating in a shorter time interval. So therefore, it's a little bit more of a riskier a choice to go with. Even though Under Armour does have a significant value market share and cost of equity at 11.5%, whereas Nike's at 5%. As we get into more about the company value, the financial reconstruction actually does affect their market value. The differences in between the results suggest that if Nike were to decrease its debt and equity ratio from 11% to 7%, their market cap would actually increase from 78 billion to 82 billion. And that's the same approach with Under Armour. If it was able to do the same, it would increase its market cap from 15 billion to 21 billion. Normally, a higher debt-to-equity ratio suggests that the company is aggressively financing debt on their side. But does debt necessarily create more risk? And that all depends on several factors that have to be measured to calculate that additional risk. For Nike, for example, has very little debt and has higher earnings and overall better capital structure than Under Armour. So at this point, the scenario wouldn't be best for Nike to consider on taking more risk. But there are actually pros for carrying on more debt into their company structure. One good incentive for doing so is the tax deductible on various interest debt bearing that any company might carry. But obviously, one of the cons of accumulating more debt is the risk of defaulting on those financial obligations. So as I mentioned about the capital reconstructing and the various effects that it has on the company value, I'd like to transition into the competition of Nike and Under Armour. The main two competitors in the industry are Adidas and Columbia Sportswear. It's actually a pretty big variance between the numbers of market cap-wise goes. By adding Nike and Under Armour market cap, that totals to a 95 billion market cap. Whereas when we combine Adidas and Columbia Sportswear, it combines to a 3.5 billion market cap. So as you're able to see between those numbers, Nike and Under Armour are by far one of the superiors in their industry. Including with having one of the best numbers, Under Armour within that industry has the higher operating margin of 11%, whereas Nike has a higher net income of $3 billion. As far as we conclude our last slide with the stock prices of both companies, we were able to implement the free cash flow equity valuation model, and after completing or doing that model, we were able to calculate the cash flows for the next 5-year period, and that gave us the information on exactly if Nike and Under Armour were priced fairly to the market. The current price that Nike was trading at is $91.86. After the calculation, the valuation estimate suggested that the price is 120.90 per share. So that means that Nike is considered undervalued. And the same approach was with Under Armour as well. We were able to calculate the valuation estimate with the free cash flow equity valuation. So currently, Under Armour was trading at $73.78, and with the valuation estimate, we got a total of $103.64 per share. So also, it was striking that both companies were undervalued. So this is actually a very good sign for value investors finding companies like this, because in the long term, they are able to gain a lot from both investments in the long run.
Well, thank you very much, Mr. Ruben Zamora. We would also very much like to thank everybody for participating and enjoying this video. And we will now answer any of the questions that you have. All right, thank you very much.
Thank you.